Cathay Pacific Airways Limited is a Hong Kong-based flag carrier. The airline is headquartered at Hong Kong International Airport. Along with its wholly owned subsidiaries Cathay Dragon and Air Hong Kong, the group operates 240 passenger and cargo aircrafts to more than 248 destinations in 54 countries. In 1946, Cathay Pacific was founded in Hong Kong by Roy Farrell and Sidney de Cathay. Business expanded quickly in the 1960s and the airline prospered, buying its rival Hong Kong Airways and becoming one of the first airlines to fly international flights. By 1973, Cathay Pacific is carrying 1 million passengers on average per year. Ever since then, Cathay Pacific has been deeply committed to Hong Kong, developing the city into one of the world's international aviation centers. The group currently has 3 wholly owned subsidiaries: Cathay Dragon, a regional airline based in Hong Kong; Air Hong Kong, an all-cargo carrier offering scheduled services in Asia; and last, Hong Kong Express Airways Limited, a low-cost carrier acquired in July 2019. Today, Cathay Pacific and subsidiaries employ more than 32,000 people worldwide. Its 2 major shareholders are the Swire Group and Air China, who own 45% and nearly 30% of the company's share respectively. The remaining 25% is public shareholding. Cathay Pacific is also a founding member of the One World Global Alliance, whose combined network serves more than 1,000 destinations worldwide.
2018 was a notable year for Cathay Pacific as they saw an end to the losses that plagued the company in the last 2 years. As evident from the data, we can see that the airline has reported a considerable increase in profits in the year 2018, following the years of losses in 2016 and 2017. These losses were largely attributed to bad fuel hedging contracts going wrong and intense competition in the airline industry. The recovery of the airline from its past losses can be seen from the significant rise in EPS and return on capital employed. Further, the dividends per share rose from 0.05 Hong Kong dollars to 0.3 Hong Kong dollars. This jump in profit can be attributed to the significant reduction in the company's losses from fuel hedging, a decrease of 77.3% as seen. However, the firm's current ratio fell from 0.80 to 0.61, indicating that they have insufficient current assets to cover their current liabilities. Cathay's ratio analysis indicates a weaker financial performance than its competitor, Singapore Airlines. This can be seen by comparing the firm's net profit margin and ROE, which are 2.1% and 3.67% respectively for Cathay, compared to 4.1% and 5.2% for Singapore Airlines. 2019 marks the end of Cathay's 3-year transformation plan, which aims to reduce expenses by 4 billion Hong Kong dollars over 3 years through investment in technology and fuel-efficient aircraft. We can see this from the cash flow statement, as the firm has a cash outflow in the investing activities section as well as a significant cash inflow in terms of new financing in both 2018 and 2017 to finance this investment. Acquisition of Hong Kong Express in 2019 will further strengthen the firm's market share in Hong Kong, as it will increase its share in seat capacity from 46% to 50%. Despite this, Cathay's growth in number of passengers carried and passenger capacity was comparatively lower than Singapore Airlines, indicating that Cathay may be performing weaker than its competitors. 2019 has been a tumultuous year for Cathay, with the first half of the year being affected by US-China trade tensions, leading to a decline in cargo revenue by 11.4% compared to the same period in 2018, and the second half of the year being affected by the anti-government protests. Despite this, shareholders of the Cathay Pacific Group received an attributable profit in the first half of 2019 as opposed to an attributable loss in the same period of 2018. The strategy of the company and how it plans to deal with the regulatory risks posed by the civil unrest will determine the future performance of Cathay Pacific.
To demonstrate the strategy and outlook of Cathay Pacific, we will develop three perspectives: customer investment, process transformation, and airline synergy. Cathay has always been dedicated to providing innovative experience for the customers. The importance of innovation is supported by the creation of Innovation Council. For instance, with the new increased focus on well-being, the airline has recently started providing long-distance flyer with access to a series of yoga videos that can be done in flight. The airline also has a collaboration with Black Sheep Restaurant to improve in-flight food. In terms of process transformation, the company has formed a central digital team to advance digital transformation, which I expect to add the competitiveness in the industry, along with providing financial and operating benefits. The team is introducing machine learning, blockchain technology, and robotic process automation, with the aim of making information more accessible and easy to analyze, thus aiding effective decision making. Lastly, airline synergy is playing a crucial role in strategic business development. Because holding with Air China not only contributes considerable income for the group, but also strengthens the competitive position of Cathay in China by attracting more customers from mainland. Lack of capacity and runways in Hong Kong International Airport currently constrain Cathay's ability to enter low-cost carrier markets. However, the company overcome this problem by acquiring HK Express this year, which opened the LCC market for Cathay. This acquisition also completed Cathay's airline service portfolio. Just like Cathay Pacific, Singapore Airline also has a complete service portfolio including international and domestic full service, budget airline, and cargo business. Singapore Airline differs from Cathay's strategy in the sense that they invest in budget airline in other countries, such as Vistara, an Indian airline company, and Nok Scoot in Thailand. This strategy enabled the company to gain competitive advantage from emerging market, which is lacking in Cathay, whose subsidiaries are mainly limited to Hong Kong and China.
The airline industry is becoming increasingly regulated. Maintaining operational and financial performance involves complying with these regulations. The biggest regulatory risks faced by Cathay Pacific presently are the issues raised by the anti-government protests rampaging in Hong Kong. Being a leading carrier in Hong Kong, Cathay has been heavily affected. On 9th August, a regulatory directive by the Civil Aviation Authority of China called for a suspension of staff involved in the protests from flying over or into China. This poses a problem as many of Cathay Pacific flights fly over the Chinese airspace. 30 staff have been fired so far with regards to this. Management has urged their staff to try to avoid infractions. To battle the Hong Kong protest fallout, Cathay has frozen hiring and cut some of their long-haul flights. It has delayed the delivery of 4 Airbus aircrafts and will retire an estimated of 10 aircrafts in 2020. The company would also scale back its capacity by 1.4% for 2020 instead of the initial growth capacity of 3.1%. It is also offering cheaper airfares, promoting destinations to fly to other than Hong Kong, as well as reducing the frequency of flights. Having accounted for the significant pressure on its earnings, the group lowered its full-year profit forecast, expecting its second-half profits to be significantly lower than the first half, leading to a possible annual loss. Another new regulation affecting the airline industry is the implementation of IFRS 16, also called HKFRS 16 in Hong Kong standards. Under this new standard, nearly all lease contracts will be on the balance sheet of the lessee, and estimates suggest that this would significantly affect the balance sheet of airlines worldwide. The adoption of HKFRS 16 in Cathay Pacific has already led to assets of 17,350 million Hong Kong dollars being brought into the balance sheet on 1st Jan 2019. One of the significant effects of HKFRS 16 is on net borrowings. The net borrowings under the impact of HKFRS 16 increased by 33.5% as compared to the expected 4.2% increase without the adoption. From this graph, we can see that the net debt to equity ratio raises from 0.92 pre-adoption of HKFRS 16 to 1.25 post HKFRS 16. To ease the transition to HKFRS 16, the group applied the following permitted recognition exemptions.